Solar stocks burn investors is the topic of today's presentation. One of my pet peeves is when people start talking about stock price performance, whether that's positive or negative, without putting it into context. So we're going to look here at year-to-date returns, and when we think about solar stocks, we want to consider what benchmarks are appropriate to use. So I've just put a few down here. We have NASDAQ. That's returned 36% year-to-date. And the S&P 500 has returned about 14%. But when it comes to energy, and I simply took a large energy sector ETF here, XLE, that's down 1%. And then when we look specifically at solar, we can see that the largest solar ETF out there, TAN, has lost 39% year-to-date. So it's fair to say that solar stocks have burnt investors. But the largest solar stocks, two of those three, have really done some damage. So to determine the three largest solar stocks, we can go to TAN, that's the largest solar ETF, and look at the weightings there. So 25% of that ETF is exposure to SolarEdge, Enphase, and First Solar. So SolarEdge and Enphase have both lost around 70% year-to-date, while First Solar has held up fairly well, gaining just 1%. Now, the reason for these losses are the old macroeconomic headwinds, and we're going to talk a fair bit about these today. You have inflation, so that's the cost of goods sold increasing, which means your gross margins decrease and ultimately your prices get raised. For example, wind turbines, 66 to 79% of a total turbine mass is steel, and the price of steel has gone up. Well, the cost of wind energy projects goes up as well. You have supply chain disruptions. This mainly refers to the giant panda in the room, China, that's responsible for 80% of the total solar supply chain, in particular the raw material used for solar panels, polysilicon, and you have higher interest rates. These significantly impact project work. So just a little bit here about interest rates. When they go up, future cash flows become worth less today. That's the time value of money. It's something we covered in our recent presentation on financial literacy for kids. It's a basic concept. We'll look at that more here in a second. You have interest-bearing assets losing their appeal. So why are you going to go invest in a 5% corporate bond when you can get that same return, quote-unquote, risk-free, just by putting the money in your bank? Financing projects becomes more difficult because of higher interest rates. Say 13% car loans are a great example of that, or any loan that you look to take out on the retail side. Utility stocks in particular don't fare well. We've noticed that lately in our own portfolio, and that's because those yields lose their attractiveness in the same way that a bond loses its attractiveness. And of course, utility companies have a lot of internal debt. Now, I wanted to look quickly at net present value. So this is something they teach you in B school. You do these exercises all the time, but it's fairly useful and intuitive. So let's say that we were going to do a solar project that cost $25,000 today, and it was going to generate cash flows in the future for 5 years. You can see the table along the top there. Well, when we look at cash flows, we want to discount them to today's values using interest rates. The idea being there that if you took that money and you put it in the bank, it would be generating cash, so you're receiving it later. That means that you should receive less of it. So the present value of that $25,000 project at 3% interest rates would be $27,500. We simply calculated that using that table on the top there. In other words, you're going to do that project because it has a positive net present value. You'd make, $2,500 in the project. But when interest rates go up 500 basis points to 8%, look at how that affects the present value of those future cash flows. Now they're below $25,000. We say, well, we're not going to do this project. That's what's happening in solar. That's what's creating that decrease in demand for solar hardware that's affecting SolarEdge and Enphase. Now, when we look at clean versus dirty energy, this has become somewhat political, but it all comes down to costs, because the capitalist societies that are building these various forms of energy generation care about what's cheapest. So clean energy technologies like wind and solar, require a lot of capital upfront to build these projects out. Higher interest rates make it more costly to borrow that money, and it can significantly increase the cost of a project, not to mention the net present value example that we looked at. On the flip side, gas and coal, those depend largely on the cost of the fuel rather than the cost of building the project in the first place. So what we can do is look at something called levelized cost of energy. Lazard produces this. It's what we base a lot of our decisions around when it comes to looking at which energy generation forms are cheapest. This is very interesting. So a 2020 analysis from the International Energy Agency showed that a 5% rise in interest rates would increase the levelized cost of electricity for a natural gas plant marginally, while it could increase the cost of electricity from wind and solar by a third. So that's a big problem. Suddenly, these clean energies aren't looking so attractive. And here's the levelized cost of energy comparison from Lazard. And I've highlighted renewables there so that you can see how solar PV, so that's rooftop residential at the top there, that's not a very good price point, right? Because you can get solar PV community there at much cheaper, and then look at solar PV at utility scale. So that's along with wind, you can see below that. Those are well competitive with, well, they're actually cheaper than a gas combined cycle plant. But what you need to focus on here is the average, and that's what's going up. So this chart here from Lazard is very informative. It shows how the average of solar PV, so photovoltaics at a utility scale, went from $38 to $60. So it's jumped sharply. Though it's been decreasing over time a lot, it's now jumped sharply, which will, of course, result in a lower demand for solar hardware. Now, the solar thesis in a nutshell, you can see that here. In 2050, solar is expected to be the dominant form of energy, and that's what we're investing in, is this future growth. Now, when we sell disruptive growth stocks that we're holding, we do so because of three reasons. The first is an objective one, if they become too heavily weighted in our portfolio, but the other two are more subjective. When revenue growth stalls or when the thesis changes. So when we consider solar stocks, we did this piece in the 10 biggest solar stocks in the world, and we felt that back then this was the top 10, though First Solar has now edged its way to the top. But we felt that three companies were worth looking at: SolarEdge, Enphase, and First Solar we actually avoided because we didn't feel that a U.S. producer of solar panels was going to fare well in the face of heavy competition from China. Now, when we look at the top 10 holdings for the TAN ETF, they account for 58% of that total ETF. You can see here some other names in there as well: Array Technologies, Shoals, we recently covered them, and Sunrun. We've looked at all of those in previous articles. Now, the interest rate problem that's affecting solar companies could be problematic if it persists. And you can see this scary article from The Economist says, markets think interest rates could stay high for a decade or more. Well, that's not good. But what we do know for sure is the Fed now expects to keep interest rates over 5% through 2024, which means that rates for mortgages, personal loans, credit cards are going to stay near their current high levels. When we look at rising interest rates, this was from a piece that Time magazine did. It's quite good. It looks at how bankruptcies increase as interest rates increase, and that traders often joke that interest rates go up until something breaks. Well, in the spring of this year, something did break. That was banks. Those banks own lots of government bonds, which lose value as rates rise, as we discussed, right? The jump in the yield of 10-year treasuries from 1.5% at the end of 2021 to around 3.5% a year later drove down the value of a broad index of treasury bonds by about 10%. So you can see how those can have damage inflicted very quickly to the tune of $600 billion for American banks, of which Silicon Valley Bank and First Republic suffered runs and they failed. So rising interest rates are no joke, and we're because they were so sudden, we're now starting to see the outcome on certain industries and certain niches of these higher rates. And when it comes to solar stocks, we're now more focused on surviving than thriving, at least through these times of turmoil. We just published this piece here. Are the big three solar stocks in trouble? That looks at Enphase, SolarEdge, and First Solar, and examines whether or not these companies are going to run into trouble with their revenues being decimated. It's quite a good read, and that would be something that you'd want to read after this video. I'll put a link to it in the description of this video. If you found this valuable, please do like this video and help share our message. So just to conclude, as solar projects are being affected by interest rates, we talked about why that is. Fewer solar projects means less demand for hardware. That's what we see. And solar equipment manufacturers are going to suffer as a result. Whether or not you're purchasing value, a discounted asset when you buy solar stocks, or falling knives, it really comes down to survivability, and that piece goes into that. But the bigger concern is just how long interest rates will stay high. So I'm going to put up another video here that you might enjoy. Before you click that, please subscribe to this channel, support our work. We don't run ads. We need your help. Thanks so much for taking the time to watch this today.